This Week in Economics on the 7th of November 2015. This will air on the 7th and on some outlets on the 8th of November, but nonetheless it'll be current, whatever date it is, numbers man here. And we'll start this off with a little bit of background about what is happening. The new rate of unemployment or redundancies at 5%. 271,000 jobs created. We'll get to more details in a minute. And that was from the Department of Labor. And in addition, the average, I'm reading from Reuters here, the average hourly earnings rose a respectable 9 cents. Could have been 10 cents. But it was under a dime. And of course, a dime is not what it used to be. The unemployment rate now stands at its lowest level since 2008. And let me just flip over here and basically explain what is going on. Then we'll come back to Reuters. An interesting little article in the New Yorker by John Cassidy. He is talking about the 271,000 jobs. At one time, even Dr. Yellen believed that basically you had to create about 350,000 jobs to deal with the slack. Now there are different situations, so let me just go to his article here. The last bit of prognostication was premature, but it does seem highly likely that Chair Yellen and her colleagues will act as recently as Wednesday. She declared a December rate hike as a live possibility, a new term. For the past few months, the Fed has been indicating we're going to see continual improvement in the labor market. Since the monthly job numbers jumped around a lot, a set of numbers should be treated with caution, no doubt about that. In the past few months, however, the economy has created almost 200,000 jobs a month. The unemployment rate has come down from 5.3 to 5%. There are even signs in the October report that wages, which have been lagging for years, are finally picking up a bit. And that is just a bit. At 5%, the unemployment rate is now about the minimum level, and that's to be emphasized. The Fed believes is consistent with stable prices over the long term. If the economy keeps expanding in the months ahead, and it seems likely the unemployment rate will probably drop below 5%. We used to think of that at 2.5% as quote-unquote full employment, and then we started to look at it as 4%. Now 4.5% there. The unemployment rate will probably drop below. Let me just keep going. He had an earlier post, won't go into that, but the consumer price index for all items did not increase at all if you exclude food and energy. Other items with the volatile prices, the annual rate of inflation is at 1.9%, which is below the mythical 2% target. With inflation, quintessential an argument can be made for the Feds to hold the fire. Despite a strong jobs report, which is not that strong, if you include people who are working part-time for economic reasons, we'll get into those when we do the jobs report from the Labor Department, and who want a job, who haven't actively looked for one in the past 4 weeks. Now remember, that's 4 weeks. The unemployment rate would stand at 9.8%, which is 1.4% point above where the measurement stood in December of 2007. Now, that was the beginning of the Depression. Some call it Great Recession. We won't quibble there. In addition, a big reason that the unemployment rate has come down so far in recent years is that many Americans dropped out of the labor force during and after the Depression. He used recession, we'll use depression. In the 8 years from December 1999 to December 2007, that's when the Great Party started, the total number of people in the workforce, which is that is non-institutionalized adults. Now I have to give non-institutionalized adults because people in quote-unquote prisons do work. Age 16 to 64 who are working or looking for work went from 140.2 million to 153.9 million, a jump close to 14 million, largely reflecting growth in the population. Since December of 2007, the population has continued to rise steadily, but the number of people in the workforce has climbed just 3.1 million, from 153.9 million to 57 million. Relative to previous 8 years, that is a drop-off of more than 10 million. So 10 million is our slack. We'll call that in. Anyway, nonetheless, since December of 2017, it is the labor participation rate has fallen from 66% to 62.4%, its lowest rate since the 1970s. Remarkably, the participation rate has fallen this year when the unemployment rate has dropped to 5%. In October 2014, it stood at 62.8%. So that is some of the relative figures there where it stands. So there is plenty of slack still out there. Let me just take care of one other little thing here. The issues that many textbooks, these economic textbooks, were written for weren't written for today's environment when GDP growth is slow, the participation rate has tanked, inflation is almost invisible, financial markets are inextricably tied together, and the Fed's decision impact the rest of the world more or less. That is the actual conditions out there, a globalized economy, and that the participation rate is not what it used to be. Thus, those textbooks are outdated. And a lot of people that are still taking economics courses in 2005 are basically still using more or less the same textbooks. They've been revised and many have been rewritten 40 years ago when we took micro and macro economics. So again, this is one of the reasons why you have the situation that we have today, outdated thinking. Now back to the Reuters report here. The dollar rallied to a near 7-month high against a basket of currencies as investors brace for higher borrowing costs. U.S. Treasury debt price fell with yields of 2-year notes hitting a 5.5 year high. And the rates futures implies a 70% chance of the Fed increasing rates in December, up from 58% chance. In other words, the last year game, the rates could rise. We've indicated that conditions look like they would be right for an increase. That's from Dr. Charles Evans. He's the head of the Reserve Bank in Chicago, who has argued against a rate hike and said in an interview with CNBC, the real side of the economy is looking a lot better. And the Reuters survey of banks that deal directly with the Fed shows 15 of 17 so-called primary dealers expect monetary policy tightening next month. That's compared with only 12 dealers in September. So we've got 3 more of them on board. Economists have forecast non-farm payroll increasing 180,000 last month, and the unemployment rate at 5.1. Well, once again, they missed the boat. The report added to a strong service sector and automobile sales data in painting an upbeat picture of the economy. It bolsters the view that economic growth regains momentum this quarter after breaking sharply to 1.5% annual pace. That's July through September. It's normally, in the past, we have some slowing during the traditional summer months. That's not unusual at all. September were revised to show 12,000 more jobs created than previously reported. That's not unusual either, because those months are pretty volatile. Payroll gains, wages gains, a measurement of how take-home pay increased 0.6% in October, was up 4.6 over the past percent during the past 12 months. A lot of information there. The economy has regained momentum just in time for the holiday season. That's from Bob Hughes. He's a senior research fellow at the American Institute for Economic Research in Great Barrington, Mass. Well, the holiday season is very important, and we'll be looking at that, which will start this month from Turkey Day on to when St. Nick comes down the chimney, if there's a chimney there for him to come down. But now to the employment participation rate rose to 59.3% from 59.2% in September. But the labor force participation rate, the share of working age Americans who are employed or at least looking for a job, held at that's a 38-year low of 62.4%. We talked about that before. Now we're back to it. Now the employment population ratio at 59.3 and the participation rate at 62.4. Manufacturing added jobs. We'll get to that when we do the numbers there, and we'll leave Reuters behind. But we wanted to add a little bit of commentary. Excuse me. Basically, what is happening here, and this way we'll get back to energy. We can actually see where things are now. This is the employment situation. We always go to it. It was released on the 6th of November, which it was Friday. Total non-farm payroll employment increased to 271,000, a 5% unemployment rate there. And this is the household survey data. Both employment rate of 5% and the number of unemployed persons at 7.9 million were essentially unchanged in October over the past 12 months. The unemployment rate and the number of unemployed persons were down 0.7% and 1.1 million respectively. Among the major work groups, the unemployment rate for adult males at 4.7%, adult women slightly lower at 4.5%, teenagers at 15.9%, we'll call it 16%. For Europeans, 4.4%, for African Americans, 9.2%, for Asians, 3.5%, and Latinos, 6.3%. It showed little change in October. The number of long-term unemployed, those jobless for 27 weeks or more. Now remember, this is only 27 weeks. This is not for people that have been unemployed 5 or 10 years. Was essentially unchanged at 2.1 million in October. As little change since June. These individuals amount for 26.8% of the unemployed as of October. The civilian labor participation rate was unchanged at 62.4% in October, following a decline of 0.2% in September. The employment proper population ratio, we just went over it, was 59.3%. The number of persons employed part-time for economic reasons, often referred to as involuntary part-time workers, edged down 269,000 to 5.8 million in October. These individuals were working part-time because their hours had been cut back, etc. And over the past 12 months, the number of persons employed part-time for economic reasons has declined 1.2 million. In October, 1.9 million persons were marginally attached to the labor force, down to 276,000 from a year earlier. And this is not seasonally adjusted. Among the marginally attached, there were 665,000 discouraged workers in October, quite a few there. Little change from a year earlier. The remaining 1.3 million persons marginally attached to the labor force in October had not searched for work for reasons such as school, etc. And this was basically what Mr. Cassidy was talking about in his New Yorker article. Total non-farm payroll employment increased 271,000 in October over the prior 12 months. Employment growth has averaged 230,000 per month. In October, job gains occurred in professional and business activities, healthcare, retail trade, food services, and drinking places. Employment in professional and business services increased 78,000 in October, compared with an average gain of 52,000 per month over the past 12 months. Job gains occurred in administrative and support services, 46,000 there. Computer systems design related services, 10,000. Architectural engineering services, 8,000. Healthcare added 45,000 jobs in October within the industry. Employment growth as containing ambulatory healthcare services, 27,000 in medical centers, hospitals, 18,000. Over the past year, healthcare has added 495,000 jobs. Employment in retail rose 44,000 in October, compared with an average monthly gain of 25,000 over the past 12 months. In October, job gains occurred in clothing and accessory stores, 20,000 at general merchandising stores, 11,000. Automobile dealers, that's a bright spot, 6,000. Food service, drinking places, bars, saloons, etc., pubs, 42,000 jobs in October of the year. The industry has added 368,000 jobs. Construction employment increased, and we like to see this at 31,000 in October, following little employment change in recent months. Employment in non-residential specialty trade contractors rose 21,000 over the past 12 months. Construction has added 233,000 jobs. Employment in mining, that would include such things as the oil fields, trended down in October, 5,000. The industry has shed 109,000 jobs since reaching a recent employment peak that was in December of last year, 2014. Employment in other major industries, including manufacturing, wholesale trade, transportation, warehousing, information, financial activities, government, showed little change. The average work week for all workers on private non-farm payrolls remained at 34.5 hours in October. Manufacturing work week was up 1/10 hour to 40.7 hours, a little overtime built in there. The average work week for production and non-supervisor workers on private non-farm payroll edged up 1/10 hour to 33.7 hours there. In October, the average earning for workers on private non-farm payrolls rose 9 cents to $25.20, following a little change in September. Hourly earnings have risen by 2.5% over the year. Average hourly earnings of private sector production and non-supervisory workers rose by 9 cents to $21.18. The change in total non-farm payroll employment for August was revised from 136,000 to 153,000. We talked about that before. This is the actual number. The change for September was revised from 144,000 to actually downward to 137,000. With these revisions, employment gains in August and September combined 12,000 more than previously reported. Over the past 3 months, job gains averaged 187,000 per week. So that is the information that we have out there to report. Now we'll just jump back we'll just jump over to the BBC, and we'll attack it from more of the quote-unquote global demand part of the scenario. A headline to BBC, job data lifts U.S. Rates rise prospects. We'll just look at it from on quote-unquote the other side of the pond. And see where they got. Astonishing numbers. The recovery since then has been slow, but October's job reports help persuade the policymakers that the time has come for the first raise in interest rates since June of 2006. So they say. That was an astonishing number. It's pretty clear that the Fed would be justified in a hike in December if the economy doesn't hit another air pocket. That's from Brian Jacobson. He's a portfolio manager at Wells Fargo Funds. And that was now from the Bureau of Labor Statistics, shows jobs rate has fallen to 5%. We won't go over that. The strength of the labor market is an important consideration for the Fed, no doubt about that. And some economists think that rise in December would start a series of rate hikes. Well, the Fed has already talked about that. There would be a series of rate hikes, but in a very, very pragmatic manner. An increase of more than 250,000 number of people working. And we won't go into this because we've already went over that. The dollar jumped following the report, adding 1.5 cents a euro, half euro cents to there, and against the pound it strengthened more than $1, roughly $1.50. Market calendar, December 16th. Markets are aggressively pricing the first federal rate for next month. That is from Christopher Vecchio at something called Daily X, his analyst there. The U.S. dollar is soaring across the board. That doesn't help any national pricing boss, so to speak. The board this month, after September, job figures blew past expectations. Well, expectations were very low. The job creation was strong. Anyway, will Chair Yellen be the Grinch this Christmas? Investors think so. The results of October's job report were pretty terrific unless there is a sudden reversal next month. It looks like the Fed will raise an interest rate in December. The economy returned to health. Well, that is with a qualification. We've already went over those qualifications as to where it will or will not, as they say, be going. And a lot of speculation there, but in actuality there will be very little of so-called rate hike. I think it's something like 25 basis points or something to that effect. I'm not exactly certain as to where it will go, but it will be minimal, more psychological, and that is back to Mr. Cassidy and the quote-unquote economic textbooks, which are not exactly where they should be. So Chair Yellen actually testified before the Finance Committee of the House of Representatives there, and we'll look at this is from the Wall Street Journal. And also Market Watch testimony there, and we'll look at it very, very quickly here. And basically, this is some of the testimony. Yellen testified. These are won't get much into that. What she testified to, just looking at scanning over here. At this moment, banks with more than 50 billion in assets face tough oversight from the central bank. That was from the Wall Street Journal. And there's not been, I'm just kind of summarizing here, the Fed Vice Chair for Supervision, as directed by Dodd-Frank, hasn't been appointed yet. And so forth and so on. Let me just get to a little better summary here of actually what is going on. Here we go, right here. Oh, oops, no. We won't be going right here. Usually it is posted at the Fed's site, but we'll go to real economics. This is out of the Wall Street Journal. She did testify before that committee, and again, it's to the possibility of the rate hike itself, and basically that was it. It wasn't covered as widely by the media as we had expected it would be, but sometimes you know how things go. We don't get to exactly where we should be, especially in when you start talking about economic matters. But basically speaking, the information does flow much better now than it did years ago out there. This is Business Insider. They tend to cover it a little bit differently, but the headlines are where the economy, well, we won't get to all of that. The possibility of rate hike this year is held out there, and she called it a lively possibility. And this has been quoted by a number of people. The chair Yellen said the economy was performing well, and that a rate hike in December was a lively possibility, and certainly a more hawkish or aggressive posture for the Fed has been collaborated by the highest profile data yet. And basically that is where we are on that particular rate hike, if it does occur. And again, this is a sort of a wait and see situation where we'll be, as they say, looking to see where we are going here with this, and we'll just basically wait and see where she's going here. Let's see if we can get a view from the New York Times. We're just heading around looking at various prospects. Well, there's still a possibility. This is from the Times. The Fed could hold back the underlying events in the past jobs report will strengthen the hand of monetary policy hawks. Well, yes and no. There's been a lot of talk here about what is going on, and various people posturing, as one would say, and that's about all we can say. White collar employers. This is a little anecdotal stuff. This is Ernst & Young, the accounting and consulting giant, has been on nothing more than a hiring binge. The company, on the course of in the course of the company's 2016 fiscal year, began in June. They plan to hire 17,000 new workers, roughly 10,000 joining straight out of university. Now, this has been unforeseen in years before. So we'll see how that is shaping up going into 2016. Things tend to, as they say, finally come around. It always takes, when you start looking at economy, it always takes a while for things to go to the levels that one would expect, and it is usually very, very slow indeed for these types of things, as they say, to materialize. And we've been looking at this for a very long time in terms of where it is going, and business usually catches up with the prevailing economic conditions. Businesses are very, very slow in doing so. So we are now seeing some events materialize that take a very long time to actually come out there. So, well, I guess one could say we'll just have to wait and see where they go in December. But again, it'll be a very pragmatic approach. Don't expect any gangbuster type events to take place when we do in fact see it happening. So we'll just, as they say, hold our hats. I think more importantly, we'll see what happens in Q1 of 2016 than in what happens at this, as to say, stage of the game. Because right now, what we have is the beginning of something perhaps new, but at the same time, it is a situation that we haven't been anticipating for over a year for this to actually happen. So now that it perhaps could become a reality, we sort of sat and we wait on it, and there's a lot of speculation to it. We're back to the BBC here, and we'll try to find where we left off here. Now we'll just start over again. And we'll go to the global part, and we'll actually do the jobs. A couple of other things here, high marks, depending on how you look at it. The President Obama rejected the Keystone Pipeline. That is gone. And we'll just have to, as they say, the Canadians, their economy is in the tank, and it will stay in the tank there. Now, the German industrial output drops, and that's very important in terms of global economy here. Dropped in September. Production fell 1.1% from the previous month. That is from the country's statistic agency, Destatis. The fall was surprised, with some economists expecting industrial output to rise. Well, the global slowdown has definitely hurt Germany. A slowdown in some emerging markets have weighed on the production. That's from the economic minister of Germany. After great developments in the first half, German industry is currently experiencing tight headwinds from the world economy. In the 3-month comparison, factory production at 0.3%, fewer goods in July to September period, with increasing construction not fully offsetting the fall in manufacturing. And Germany is a hands manufacturing economy there. So again, that is one of the things to be expected here. And we go to statistics Bundesamt. Anyway, and in September 2015, they were down 1.1%. That is from the Federal Statistical Office. The corrected figure showed a decrease of 0.6, primary at 1.2 from July of 2015. In September, production in industry, excluding energy and construction, was down 1.4%. Within the industry, the production of capital goods decreased 1.4%. the production of intermediate goods by 0.4%, and the production of consumer goods by a 3.2%. Energy production was up 0.3% on previous month, with production in construction fell 0.9%, almost a percent. The rate of change referred to in the production index of industry season and workday adjustments is done. Well, we won't get into the Series X12 methods here, but this is from Hans Moeller. So that is whom you would talk to there at Destatis, and the German operation. So now let's back to the BBC, and we'll get the rest of the story, as one would say, from the international standpoint. We're trying to collect more indexes here as we possibly can. UK manufacturing output strengthens, the other side of the coin, in the UK. In September, manufacturing output was still down 0.6 from a month a year ago. The widely measured industrial production fell 0.2% in September, but that was 1.1% higher than a year earlier. This other figures from the National Office of Statistics indicate that the goods trade deficit narrowed to £9.35 billion in September. The data showing that the UK's imported goods, more goods than expected, was down from a gap of £10.79 billion in August. The deficit in goods and services narrowed to £1.4 billion in September from £2.9 billion the previous month, August. And the UK economy grew at 0.5% in Q3 in its first growth estimate for the quarter. The figure shows that industrial production rose 0.2% in the July to September period, slightly below the initial estimate of 0.3%, while manufacturing output fell 0.4%. And that is from the UK. We'll go now and do the numbers that we rounded up basically where things are. So now we'll get the all-important markets, the other part of the coin, and more of, I guess, what you'd call the traditional part that many in business look to. And we'll get the stock markets here. The FTSE was down 11.007 on, and these are Friday unless otherwise reported. In Amsterdam, they were at 3.23. In Frankfurt, the DAX was at 100.29. In Paris, they were at 4.11. In Brussels, 48.95. In Madrid, 22. In Zurich, they were down 19.89. In Moscow, they were down 11.92. In Johannesburg, they were also down 294.82. In Bombay, down 287.68. In Karachi, also down 27.84. In Lahore, 22.73. In Colombo, 42.009. On Wednesday in Tehran, 115.80. In Sydney, 21.80. The Nikkei at 149.19. The Hang Seng in Hong Kong was down 183.71. In Shanghai, 67.21. In New York, 46.90. Then the Nikkei was at, the Nasdaq was at 19.38. The Merc, that's the commodities market out in the Midwest city of Chicago, they were negative at 0.76, and in San Pablo in the negative minus 1,128 or 1128.64. In Mexico, they were at 48.20 on Friday. Let's do the commodities markets, and we'll see where Brent crude was. As a big parameter. Incidentally, Brent crude futures were down 0.37. That is oil futures there. Nonetheless, Brent crude, well, okay, we gave that. Sorry about that. Brent crude, the spot, was down 98 cents. And that price was at $47.61 for the futures, and the spot at $47.37. Texas Intermediate was down 65 cents at $44.55, minus 1.4. Cocoa was down 26 cents. Incidentally, T-Boone Pickens remembers $15 a barrel gold. We always like to say that. So, again, they had $44.55. The Forex index was up 40 cents at $1,107.70. Dubai gold was down $16.10 at $1,088.40. So it tells you where things are if you want to go to the gold standard. Nonetheless, the Euronext light futures, cocoa was up $9. Robusta coffee futures was down $29. White sugar futures, I'm not sure why anybody does that, but anyway, we're down $10.30. The Bloomberg Commodities Index was down 56 cents at 85.23. So this will do it for us. For those in business, make next week a productive one. For the consumer, you obviously are keeping your eyes on the prize as we start to go through the important month of November. The holiday season kicks off right after, in the U.S. at least, after Turkey Day. And then you have various other events, Cyber Monday, you name it, you got it. And at the same time, we remind people there's also a boycott called by the Justice or Else people in their march to boycott Black Friday and Cyber Monday, called for by the minister from Chicago, one Louis Farrakhan. Interesting there. And we'll see what impact that has on the holiday shopping across the board.